Imagine a time not so long ago when money felt almost free. This was the early 2000s. It was a wonderful, bubbly, dangerously optimistic time. Banks were handing out money like it was candy at a parade. You want a loan for a new car? Here you go. You want a credit card with a limit that looks like a phone number? Absolutely. Sign here. The global economy felt like a giant party, and everyone was invited. Interest rates, the price you pay to borrow money, were incredibly low. This made borrowing very, very attractive. It was cheaper than ever to get a loan for pretty much anything you could dream of, and nobody seemed to be asking too many questions. This era of easy money created a feeling that the good times would never end. It was like being in a movie where the hero keeps winning at the casino, and you start to believe they can't possibly lose. People were buying bigger houses, fancier cars, and taking expensive holidays. Why not? The bank was happy to lend you the money. This created a huge sense of confidence. Economists and politicians were patting themselves on the back, telling everyone that they had finally figured out how to make the economy grow forever. It was a beautiful, shiny, and ultimately completely fake reality that was about to come crashing down in a spectacular fashion. The biggest star of this party was the housing market. House prices were going up, and up. It seemed like a guaranteed way to make money. You could buy a house today, and in a year, it would be worth much more. This wasn't just happening in one city or one country, it was a global phenomenon. People started to see houses not just as places to live, but as investments, like gold or stocks. This frenzy to buy houses was fueled by the banks, who were more than happy to provide the loans or mortgages that people needed to get in on the action. It was a cycle that fed itself. Rising prices made people want to buy, and all that buying pushed prices even higher. But here's the secret, the dirty little secret that no one wanted to talk about at the party. A lot of this was built on very shaky ground. The confidence was a mirage. The ever-rising house prices were a bubble waiting to pop. And the easy money being handed out by the banks? Well, that came with a hidden cost that was about to become terrifyingly clear. We were all dancing on the deck of a very expensive, very glamorous ship that had just set a direct course for a giant iceberg, and the band was playing so loudly that almost nobody heard the initial warnings. The calm was about to be shattered by a storm of historic proportions. So, how did the banks keep lending so much money, especially for houses? They got creative. And by creative, I mean incredibly, breathtakingly reckless. They invented something with a fancy name, the subprime mortgage. Now, a normal mortgage, or a prime mortgage, is a loan you give to someone with a good job, a solid income, and a history of paying their bills on time. It's a safe bet. A subprime mortgage, on the other hand, is the exact opposite. It's a loan given to someone with a not-so-great credit history, a low income, or an unstable job. It was like a casino giving chips to someone who had already lost all their money. Why on earth would a bank do that? Because they could charge much higher interest rates on these loans. It was riskier, so they demanded a higher reward. And for a while, it seemed to work. As long as house prices kept rising, everything was fine. If a person with a subprime loan couldn't make their payments, the bank could just take the house and sell it for a profit. The problem was, banks started giving these loans to almost anyone. There were stories of people getting mortgages with no job, no income, and no assets. They were called ninja loans, which is just terrifying. It was a system that only worked if the party never ever stopped. But the banks did something even more clever, and again, I mean this in the worst possible way. They didn't want to hold on to these risky loans themselves. That would be like a chef eating his own questionable food. So, they bundled them all up. Imagine taking thousands of these risky subprime mortgages, mixing them with some slightly safer ones, and chopping them all up into a giant financial sausage. They then sold slices of this sausage to investors all over the world. These slices were called mortgage-backed securities, or MBSs. It was a way for the banks to get the risky loans off their books and make a quick profit. These financial sausages were then given nice, safe-sounding ratings by special companies called credit rating agencies. These agencies were supposed to be the responsible adults in the room, the referees. But instead, they gave these bundles of junk an A-grade rating, basically telling the world, this sausage is delicious and perfectly safe to eat. So, pension funds, city governments, and investors from London to Tokyo bought them, thinking they were making a safe investment. In reality, they were buying a box full of ticking time bombs. The entire global financial system was now connected to the ability of a person with a ninja loan in Florida to pay their mortgage. What could possibly go wrong? For a few years, the house of cards stood tall. But then, the inevitable happened. The music at the party started to slow down. The low introductory interest rates on all those subprime mortgages began to go up. Suddenly, people who could barely afford their monthly payments were faced with bills that were much higher. At the same time, the magical rise in house prices stalled. In fact, in many places, prices started to fall. This was the moment the whole system began to unravel, like a poorly knitted sweater snagging on a nail. It started slowly, with a few missed payments here and there. This created a double problem. First, people couldn't afford their new higher mortgage payments. Second, they couldn't sell their house to pay off the loan because the house was now worth less than what they owed. This is called being underwater on your mortgage, and it's a terrible sinking feeling. Imagine owing the bank $300,000 for a house that is now only worth $200,000. You are trapped. As more and more people found themselves in this situation, they had no choice but to stop paying. This is called a default, and the number of defaults started to rise, first like a trickle, and then like a flood. Now remember those financial sausages, the mortgage-backed securities that were sold all over the world. They were suddenly full of rotten meat. The loans that were supposed to be providing a steady stream of income were failing. Investors who thought they had bought a super-safe, A-grade product suddenly realized they were holding a piece of paper that was becoming worthless. Panic began to set in. No one knew exactly how much of this toxic stuff was out there, or which banks were holding it. The trust that holds the entire financial system together began to evaporate overnight. It was like a game of musical chairs, but when the music stopped, everyone realized a lot of the chairs were actually holograms. Banks, which lend money to each other every single day to keep business flowing, suddenly stopped. They were too scared. Bank A didn't know if Bank B was secretly holding billions of dollars of toxic assets that could make it go bankrupt tomorrow. So, Bank A refused to lend to Bank B, and Bank C refused to lend to Bank A. The credit markets, the very heart of the economy, froze solid. It was like the oil in a car's engine suddenly turning to sludge. The entire machine of the global economy began to grind to a halt. This wasn't just a problem for Wall Street anymore. This was a problem for everyone. For most of 2007 and early 2008, the crisis was a slow-motion car crash. We could all see it happening, but the final, catastrophic impact hadn't occurred yet. Governments and central banks were trying to patch things up, hoping to avoid a total collapse. They helped rescue a big investment bank called Bear Stearns in March 2008, which felt like a close call. But the real moment of truth, the point of no return, came on September 15, 2008. That was the day that Lehman Brothers, a massive, 158-year-old investment bank, a giant of Wall Street, declared bankruptcy. This was not supposed to happen. Ever. The failure of Lehman Brothers was the financial equivalent of a nuclear bomb going off in the center of the global economy. It was a signal to the entire world that no one was safe. If a bank as big and as old as Lehman could disappear overnight, then any bank could. The panic that had been simmering for months exploded into full-blown terror. The trust between banks didn't just evaporate, it was sucked into a black hole. The stock market went into a freefall, wiping out trillions of dollars of value in days. It was a complete and total meltdown. This was the moment the crisis went from being a big problem to a historic catastrophe. Why did the government let Lehman fail after saving Bear Stearns? That is a question people will debate forever. Some say they wanted to teach Wall Street a lesson, to show that there would be consequences for reckless behavior. This is known as moral hazard. The idea that if you always rescue people from their mistakes, they will just keep making them. Others say the government simply didn't understand how deeply connected Lehman was to everything else. Letting it fail was like pulling a single Jenga block that you think is unimportant, only to watch the entire tower collapse into a pile of rubble on the floor. The immediate aftermath was chaos. Credit markets, which were already frozen, were now put into a deep freeze. AIG, a gigantic insurance company that had insured many of those toxic financial products, was on the brink of collapse itself. Its failure would have been even bigger than Lehman's. The day after Lehman's bankruptcy, the United States government had to perform a stunning reversal and give AIG a colossal bailout of $85 billion. The The message was clear. The government had tried to play tough for a day, saw the abyss open up beneath their feet, and immediately scrambled back in terror. The financial world as we knew it was over. For a while, the crisis seemed like a problem for men in expensive suits on Wall Street. It was about strange financial products with confusing acronyms, but after the Lehman Brothers collapse, the crisis jumped from the financial pages to the front pages, and then it kicked down the front door of regular people everywhere. The most immediate and painful impact was on jobs. When the credit markets froze, businesses couldn't get the short-term loans they needed to operate day to day. They couldn't get loans to pay their suppliers or even to pay their employees, so they did the only thing they could. They stopped hiring, and then they started firing. Millions of people lost their jobs. The unemployment rate skyrocketed. These weren't just numbers on a chart. They were families who suddenly had no income. They were people who had worked at the same company for 20 years and were now told their job was gone. The job losses weren't just in banking. They were in construction, as building projects stopped. They were in manufacturing, as people stopped buying cars. They were in retail, as people stopped buying clothes. It was a devastating wave of unemployment that swept across the country and then the world, leaving a trail of hardship and despair in its wake. At the same time, the stock market crash had a direct impact on the savings of ordinary people. Many people had their life savings or their retirement funds invested in the stock market. They had been told it was the smart thing to do. In a matter of weeks, they watched the value of their 401ks and pension plans get cut in half. People who were close to retirement suddenly saw their dreams of a comfortable future vanish. They were faced with the horrifying choice of either working for many more years or retiring into poverty. It was a theft of their future, committed by a system they had been told to trust. And of course, there were the houses. The very thing that started the crisis became its most visible symbol of pain. Millions of families lost their homes to foreclosure. They received letters from the bank telling them they had to leave. Their belongings were put on the street. These weren't just people who had taken out risky subprime loans. Many were families with normal loans who lost their jobs and could no longer make the payments. The American dream of owning a home turned into a nightmare for an entire generation. The crisis wasn't an abstract concept anymore. It was an empty house on your block, a friend who lost their job, and a constant feeling of fear and uncertainty. It would be nice to think this was just an American problem, a mess made in the USA that stayed in the USA. But that's not how the modern world works. In our deeply interconnected global economy, when America sneezes, the rest of the world doesn't just catch a cold, it gets a severe case of pneumonia. The toxic financial products, those mortgage-backed securities, hadn't just been sold to American investors, they had been sold to banks and pension funds all over Europe, Asia, and the Middle East. So when those products became worthless, the pain was felt everywhere, from London to Reykjavik to Dubai. European banks were hit especially hard. Many of them had eagerly bought up American mortgage securities, thinking they were a safe investment. When the crash came, they found themselves with huge losses. This led to a banking crisis in the United Kingdom, in Germany, in France, and beyond. One of the most dramatic examples was Iceland, a small country whose entire banking system had grown to be 10 times the size of its economy. When their banks collapsed from exposure to these toxic assets, the entire country went bankrupt. It was a stunning example of how a problem that started in American suburbs could destroy the economy of a whole nation thousands of miles away. The crisis also spread through global trade. As Americans lost their jobs and savings, they stopped buying things. This meant they stopped buying cars made in Germany, electronics made in China, and coffee grown in Colombia. The demand for goods and services from around the world plummeted. Factories in Asia laid off workers. Commodity prices for things like oil and copper crashed, and developing countries that relied on exports to richer nations saw their economies stall. This second wave of the crisis, the collapse in global trade, pushed the entire world into the deepest recession since the Great Depression of the 1930s. The result was a synchronized global downturn. From Brazil to Russia to Japan, economies were shrinking, unemployment was rising, and governments were struggling to respond. What began as a housing bubble in places like California and Florida had mutated into a global economic plague. It was a brutal lesson in globalization. The same connections that had brought prosperity and growth in the good times now served as perfect channels for transmitting financial panic and economic collapse. No country was an island. The storm that started on Wall Street was now battering every shore. Faced with a complete collapse of the global financial system, governments around the world felt they had no choice but to act. The strategy they chose was hugely controversial. They decided to bail out the banks. In the United States, this took the form of the Troubled Asset Relief Program, or TARP. This was a $700 billion fund created to buy up the toxic assets from the banks and to inject cash directly into them to keep them from failing. The idea was that these banks were too big to fail. Their collapse would take the entire economy down with them, so they had to be saved, no matter the cost. This decision was met with a massive amount of public anger, and for good reason. It looked like the very same people who caused the crisis with their greed and recklessness were now being rewarded with taxpayer money. People who had lost their homes and jobs were watching the government hand over billions of dollars to the bankers who were still collecting huge bonuses. The phrase socialism for the rich, capitalism for the poor became a common refrain. It felt deeply unfair. Why were the banks being rescued while millions of ordinary families were left to suffer? It was a moment of profound disillusionment with both Wall Street and Washington. Governments argued that the bailouts were not for the bankers, but for the system itself. They were a necessary evil to prevent an even worse outcome, like a full-blown depression with 25% unemployment and breadlines. By saving the banks, they were saving the system of credit that every business relies on. They were trying to unfreeze the pipes so that the economy could function again. It was a messy, ugly, and unsatisfying solution, like performing emergency surgery with a rusty tool, but they believed it was the only way to save the patient. Whether they were right is still hotly debated to this day. Similar bailouts happened all over the world. The British government took over several major banks. Other European countries pumped billions of euros into their own failing financial institutions. Central banks, like the US Federal Reserve, also took extraordinary measures. They cut interest rates to nearly zero and started printing money on a massive scale through a process called quantitative easing to pump liquidity into the system. These were desperate measures for desperate times. They may have stopped the free fall, but they also created a new set of problems and left a legacy of public anger and debt that would shape politics for the next decade. The immediate panic of the crisis eventually subsided, but the world was left with a very long and painful hangover. The economic recovery was slow and weak. Even though the recession officially ended in 2009, it didn't feel like it for most people. Unemployment remained stubbornly high for years. Millions of people who lost their jobs struggled to find new ones, and many had to take lower-paying jobs with fewer benefits. A whole generation of young people graduated from the college into one of the worst job markets in history, setting them back financially for years to come. The crisis left deep and lasting scars on the economic well-being of millions of families. The crisis also led to significant political and social changes. The widespread anger at the bank bailouts and the feeling that the system was rigged for the rich fueled populist movements on both the left and the right. Movements like Occupy Wall Street, with its slogan, "We are the 99%, captured the public's frustration with economic inequality. This anger also contributed to political shifts across the Western world, including the rise of anti-establishment politicians and events like Brexit. The trust in major institutions, in government, in banks, in the media, was shattered, and that trust has been very slow to return. In response to the crisis, governments did put some new rules in place. In the United States, the main response was the Dodd-Frank Act of 2010. This was a huge piece of legislation that aimed to make the financial system safer. It created new agencies to protect consumers, required banks to hold more capital as a cushion against losses, and put some restrictions on the risky activities they could engage in. The goal was to prevent a repeat of 2008. Similar regulations were put in place in Europe. These rules were a step in the right direction, but many critics argue they didn't go far enough to truly change the culture of Wall Street. Today, more than 15 years later, we are still living in the world that the 2008 crisis created. Interest rates remained historically low for a decade, which has inflated new bubbles in other assets. Governments are carrying much higher levels of debt because of the bailouts and the recession. And economic inequality, the gap between the super rich and everyone else, has grown even wider. The memory of the crash has faded for some, and some of the post-crisis regulations have even been weakened. The fundamental problems that led to the crisis, too much debt, too much risk-taking, and a system that rewards short-term profits, have not entirely gone away. So, after all that chaos, all that pain, all the lost jobs and lost homes, what is the big lesson? The first, and most obvious, is that complexity can be incredibly dangerous. The bankers created a system so complicated that almost nobody understood it, including themselves. They sliced and diced risk until they thought it had disappeared, but it hadn't disappeared, it was just hidden. When things are too complex to understand, it's often a sign that something is wrong. We learned that when greed is combined with complexity and a lack of proper oversight, it creates a recipe for absolute disaster. It's a lesson we seem to have to learn over and over again. We also learned that our global economy is more interconnected and fragile than we ever imagined. A problem in one corner of the financial world can spread like a virus and infect the entire system with terrifying speed. The idea that banks could regulate themselves proved to be a complete fantasy. They are not capable of resisting the temptation of huge short-term profits, even if it means risking long-term collapse. This means that strong, smart, and vigilant government regulation is not a nice-to-have. It is an absolute necessity to protect the public from the financial industry's worst instincts. Without a tough referee, the game will always get out of control. Perhaps the most important lesson is a human one. Behind all the big numbers and confusing terms are real people. The 2008 financial crisis wasn't just about banks losing money, it was about families losing their homes, parents losing their ability to provide for their children, and workers losing their dignity. It was a story of broken dreams and stolen futures. It showed us that the decisions made in the glass towers of Wall Street and London have profound and devastating consequences for ordinary people on Main Street. The economy is not a game. It is the foundation of people's lives, and it needs to be treated with the seriousness and care that it deserves. And that brings us to today. The world has changed, but the pressure to forget these lessons is always there. The lure of easy money and quick profits is powerful. It is up to all of us to remember what happened, to ask hard questions, and to demand a financial system that serves the real economy, not the other way around. We have to be the ones who remember the story, not just of the numbers, but of the people. Because if we forget, we are doomed to repeat it. Thank you so much for spending this time with me. If you found this helpful, please do all the things that help us out, like subscribe and share it with someone who might need to hear it. Stay safe out there.